mode.
Good afternoon, guys. Good evening if you're on the East Coast or somewhere later. This is Bob Iacino from Path Trading Partners. Mike Arnold is here in the background. He'll be saying hi a little bit later. And as always, we want to thank Nadex for hosting this for us. We're always happy to talk to you guys. Just want to really quickly mention a quick sympathy for victims of the terrorist attack. I always kind of hate just jumping into business when there's something like that happens. But we have to do our work. We have to do what we have to do. So here we go. This is Nadex Binaries, trading out of the money Nadex Binaries. And as always, if I could, I'll start with a quick risk statement because we take this very seriously. This presentation is for information purposes only and does not constitute investment advice nor an offer, solicitation, or recommendation to acquire or dispose of any investment or to engage in any other transaction. This presentation is not intended for solicitation purposes, but only for use as general information. All descriptions, examples, and calculations contained in this publication are for illustrative purposes only. The risk of loss in trading can be substantial. You should therefore carefully consider whether such trading is suitable for you in light of your financial condition. Past performance is not indicative of future results. When you have an event like you had overnight, it kind of emphasizes one of the best parts about trading at Nadex, because you can't wake up to some obnoxious, life-changing margin call. So again, read those last two lines, consider whether such trading is suitable for you, and then remember, part of the reason that we're associated with a CFTC-regulated exchange is because they kind of help protect you a little bit from some of the unforeseen things that happen in the market, one of which unfortunately happened overnight in Belgium. So we are Path Trading Partners. Path Trading Partners is a trading and education firm, and our mission was to form a trading firm that educates, supports, and backs and funds traders who are committed to probabilities, discipline, and long-term trading success. And this is achieved by following the correct path, hence the name. We are not high-frequency traders. We are not day traders. What we are is a firm that believes in a long-term success in trading, covering time frames dictated to us by products, markets, and price action. You guys have heard me explain this before, but for those of you that are new, what we mean by that is we don't go in with a bias of wanting to do something. We go in with a plan, with a strategy, with a method, and we stick to that. And if the market gives us something, we take it. If the market does not, we move on, and we don't try to force trades or to, quote-unquote, make back losses by forcing things that aren't there. We trade what is dictated to us by products, markets, and price action. So who is Mike Arnold? Again, he's in the background. You'll be hearing from him in a little bit. Mike's a 24-plus year market veteran. He's been teaching traders online and in person for over 10 years, and he is and was, and of course still is, a strategy and development consultant to multiple outside hedge funds. He's a former options market maker on multiple exchanges. He traded in Chicago, New York, Switzerland, and Canada, and he is the current head of technology and trading system development for Path Trading Partners, as well as being one of our co-founders. I am in the corner there with Becky Quick. I've been around for about 24 years. I'm also a co-founder of Path Trading Partners, and I've traded virtually everything there is to trade, live and online, since 2002, and I've taught and mentored traders live and online since 2002. I've been an analyst, a prop trader, a fund-of-funds hedge fund principal, and a member of that investment committee, which is where I think I add value to you guys. I appear on a lot of the different financial channels as a guest analyst, hence the narcissistic picture in the top right. And a lot of you have probably seen me before, but if you haven't, I'll be on tomorrow, somewhere around 7:20 Central Time, 8:20 Eastern Time, on Bloomberg Television if you have that, whether you watch it on TV or online. Bloomberg streams their live television show online for free. I'll be on tomorrow morning. I've done, it's got to be 800 now, and I continue to make media appearances about 5 to 10 times per month. So let's do a quick review. In prior classes, we covered the concept of moneyness and classifying a Nadex binary option as either OTM, ATM, or ITM, which is out of the money, at the money, or in the money. And we taught the Greeks what they are and how they apply to Nadex binary options, and how they can help the binary option trader understand the price movement of the options and price changes due to Theta and Vega. Very important you know why things are moving the way that they're moving, not just that they are moving. Most of the time, Mike and I talk about just understanding the what of the market, but if you see what's happening and you don't have an understanding of the math behind it when you're talking about options, and binary options are options, it's very important to understand why these things are happening so you can plan your trades accordingly. If you need to learn these concepts, please watch the recordings of our prior Nadex binary classes after this webinar, and you can find them at nadex.com/trading-academy/webinars. Very simple, just go into education, go into webinars, go to archived webinars, and you can find them all there. After learning the Greeks, most traders wonder how they can effectively translate that knowledge and information into useful and actionable trading information, and that's precisely what we're going to do in this class when we look to trade Nadex binaries that are out of the money. However, first we're going to do a very brief review to ensure everyone is on the same page. Very important if you haven't seen the prior classes, just to do this quick review. So binary options are worth either 100 or 0 upon contract expiration, and that's per contract. If the Nadex settlement index is above the strike price of the binary option at expiration, then it's worth 100. However, if the Nadex settlement is equal to or below the strike price of the binary option, then it is worth 0. Now let's review out of the money versus in the money. We refer to binary option being out of the money if it's trading below its strike price. We refer to a binary option being in the money if it's trading above its strike price. Now, a binary option is at the money if it's trading right at the strike price. So if you have a greater than 2010 US 500 binary option, then if the underlying is trading at 2010, that is exactly at the money. But for the purpose of this course, we are considering at the money binary options out of the money, since they are worth 0 if the Nadex settlement index settles right at the money. So it is a very simple explanation as to what the money means, in the money, out of the money, or at the money. It means the money that you're going to get upon expiration, right? So if it's trading directly at the strike of the binary option, it's at the money, it's right at the price, but because if it settles exactly there, it's worth 0, we consider that to be out of the money. Here's a quick options pricing graph, and this is just so you get a visual of these, because we do use a lot of these in our presentations. You can see with 30 minutes left to expiration, the orange line kind of describes the price movement given, say, for example, a 20% volatility level. Obviously, there's volatility involved as well. But here, this blue line is at the money for a 2010 strike binary option in the US 500. So the blue line would represent at the money, and anything below it would be out of the money, and anything above it would be in the money. Now again, for the purposes of discussion, at the money is out of the money, okay, since the settlement would be 0 and there would be no value to the option if it's settled right there. But to the left, where the lower side of the curve here, that's out of the money, and above that is in the money, and this is sort of what the curve looks like, what the pricing curve looks like, with about 30 minutes left, given about a 20% volatility. Don't need to know that right now, just need to see this because there's going to be a lot of graphs later. This is what they look like. Now, very important, let's review intrinsic versus extrinsic value. Let's examine the intrinsic and extrinsic value of a binary option. Now, intrinsic value is defined as the in-the-money portion of the option value, or the value that the option would be worth on expiration. Extrinsic value is defined as the worth assigned by external factors, such as time and implied volatility. If I go back to 30 minutes left is the time, and I mentioned this is about 20% volatility on this particular example. So when you come back here, you talk about extrinsic value is the word assigned by those external factors, such as time and implied volatility. Intrinsic, simply how much is it above the actual strike. So if the underlying is at 2012 in the prior example, then that's $2 of intrinsic value for a 2010 binary option. Intrinsic and extrinsic value are very interesting when examining binary options. I think if any of you have traded traditional options before, you'll find this part pretty interesting. Unlike spreads, where the intrinsic value increases slowly after the underlying passes the at-the-money strike price, binary options increase in a digital fashion, since upon crossing the ATM strike price boundary. For example, when the price of the underlying passes the Nadex binary option at the money strike price, the intrinsic value goes from 0 to 100 instantly. That's a very interesting thing, and it's pretty obvious if you look at it, but when you read it in front of you like that, it becomes a very interesting thing again, especially if you've traded spreads or traditional option. When a Nadex binary is trading at or below the strike price, meaning at the money or out of the money, then all of the value is extrinsic. All of the value is decided by time and volatility. When a Nadex binary option is trading in the money, then the value is a combination of extrinsic and intrinsic value. But what's interesting to note is that when the binary option is in the money, the extrinsic value is negative, which is why the trading value is less than 100 before expiration. So again, think about the example on the graph we showed earlier, and Mike will go into this more in depth. But if you had a 2010 binary option, and the definition of intrinsic is what it would be worth at expiration. If the underlying goes to 2011, at expiration, that option would be worth $100. But the price of the option trading live is not 100, it's less. That's because the extrinsic value is negative. So taking a look again at what makes up Nadex binary premium, you have intrinsic value, or value at expiration, and extrinsic value, time value and implied volatility, will make up the total premium. That is an unwavering formula. It doesn't change. So let's talk briefly about Nadex binary option Greeks. So we can apply these Greeks to Nadex binary options. The definition of each Greek is as follows. Delta is the sensitivity of the binary option price to price changes of the underlying. Oops, sorry about that. Gamma is the sensitivity of the delta to the price changes of the underlying. Theta is the sensitivity of the binary option price to the passage of time. Vega is the sensitivity of the binary option price to changes in implied volatility of the underlying. Mentioned that already. And rho is the sensitivity of the binary option price to changes in the interest rate. So going back to the components of premium, we already know intrinsic is pretty simple, the value at expiration. So what goes into extrinsic value? The time until the spread expires, which we just mentioned is the theta, and the volatility of the underlying, which is the vega. Now, changes in interest rate would apply to most options, but we're not going to cover that here simply because rho does not affect binary options. They trade on such short term that we're not worried about the price change based on interest rates. You're never really going to have to deal with that. So you look for the purposes of binary option, you're just looking at extrinsic value being a combination of time until the spread expires and volatility of the underlying, theta and vega. So what are we going to do in this session? Well, in this session, we're going to examine in depth how time, theta, and volatility, vega, and market direction and momentum affect Nadex binary options when trading them out of the money. This session will only focus on trading the Nadex binary options that are out of the money. Another Path Trading Partner session focuses on trading them when they're in the money. Since the intrinsic value of an out of the money and an at the money option are both zero, we will be combining those concepts together in this session. So again, keep in mind, exactly at the money for the purposes of what we're doing is the same as out of the money. We will also mainly be focused on trading the binary options from the long side while reviewing our Greeks, just for the point of simplicity. We're not going to go through both sides of it because essentially it's the same formulas reversed. Many traders look to trade binary options when they are out of the money because they look simply at the reward to risk that you can see on your ticket and that they can get a larger reward than the risk taken. Nadex is kind enough and convenient enough to put that risk and reward right on your order ticket, and that's where your eyes go right away. And this is especially true for binary options that are very far out of the money. In order to have a chance of trading the binary option successfully, the trader needs to understand the market conditions that are best suited to initiate these kinds of trades, and they do exist. Just trading a binary option because it looks like you can make a lot of money without a lot of risk is not a sound strategy. Once you understand the market conditions that can be beneficial to putting out of the money binary option, to putting on and out of the money binary option, you will become one step closer to being a complete binary option trader. These particular, that risk-reward formula, simply because it's a bigger reward than it is risk, does not make it a sound trade without other factors being involved. So let me turn it over to Mike now and give him, or he can go ahead and give you.
Great, thank you, Bob. Good evening, everyone, or good afternoon. Hope everyone is doing great. Thank you for that great introduction. All right, let's pick this thing up. Perfect, looks like I have the mouse. Yep. All right, as Bob covered, we're looking at the long binary out of the money, which encompasses up to at the money. So that is key. So the graph, we'll be looking at this part highlighted in orange. One of the things, people brought up, well, why is, when I trade in Nadex binary, why is at the money not considered, why does it pay out 0 instead of 100 when it's at the money? One of the reasons is, if you think about what Bob just went over, intrinsically with the option, it has to go one beyond at the money. At the money is all still extrinsic value, and when the option expires, if it's only extrinsic value, it expires at 0. That is one of the reasons that Nadex binary options, which are call options, expire at the money worth 0, and if it's anywhere above, the underlines above, or as they do it with the native indicative index, which is a calculation upon expiration, if that's above your binary strike price, it is worth that $100. As this graph shows, this would be like with 15 minutes to go, this is how a curve of the binary option with a 2010 strike price at different levels of the underlying would be priced. All right, let's keep going over this concept of extrinsic value. So in trading in Nadex binary options that are out of the money, there's not any intrinsic value, okay? It's intrinsically worth 0. No matter where we are on this curve, if we are at or less than 2010, meaning the underlying is trading at or less than 2010, the price, any price you are paying for the option, as Bob said, we're looking at this from the long side, is all extrinsic value. It has no intrinsic value, okay? Since all the value is extrinsic value, time is working against the trader from the moment they establish the position. That's where the time decay comes from. And extrinsic value upon expiration is worth 0. So over time, that value decays as you get closer and closer to expiration. So if price action is stagnant and not moving further towards and through the strike price, then every minute that passes hurts the out of the money binary option trader. Time is working against you. So price overall throughout the duration of the trade has to be moving, and it better be moving for a long trade up, because just sitting there is not doing you any good. And actually sitting there below the strike price going into expiration is definitely not doing you any good, because any remaining extrinsic value upon expiration will be 0. This is especially true as a binary option gets closer and closer to expiration. The time decay, and depending on where you are, where the underlying is trading in reference to that option strike price, you know, that time decay can get quite substantial, especially if you've seen, and I'm sure many of you have seen, watching some of these binaries go into, you know, right before that quiet period that are, you know, where you can't do any of the trading, you know, well, it's going into expiration. Watching that and seeing it really close to at the money and seeing how that option value can change drastically, even if the underlying goes really quiet and it's not moving much, but it's trading on the wrong side of the in the money price, the other side of the strike price, so it would be just out of the money, going into a few minutes remaining, that option can lose value pretty quickly. That's all time decay. So let's keep looking at that time decay, or theta as we call it using the Greeks. Remember, theta is the time decay of the binary option. Theta is the time decay of any option, whether we're talking about a spread, a Nadex spread, which is made up of options, whether we're talking a standard option, whether we're talking a binary option. Theta can help or hurt the binary option trader depending on if the binary is in the money or out of the money. However, if the underlying price remains out of the money, then time's working against the trader. Next week, we'll look at these binary options in the money where it's working for the trader. Why? As Bob said, this is a little preview of next week, so hopefully you'll join us. When it's in the money, your intrinsic value is 100. But traders go, well, it's only trading like maybe 60. Well, how's it intrinsically worth 100? Because it's intrinsically worth 100. The difference between where it's trading and what it's intrinsically worth is the extrinsic value, which is negative. And when you add the time decay, which works for you when it's in the money, that's how time makes up the value. Well, now we're looking at out of the money. Time is always working against us as long as the trade remains out of the money. There's no ifs, ands, or buts about it. Therefore, theta is decreasing the extrinsic value every minute that passes. As the binary option approaches the expiration time, the time decay increases rapidly. This is one of the things we like to show you, and I haven't seen too many other people show stuff like this, these kind of graphs and these kind of charts. So these visual images, I think, really can help the trader. So out of the money, where we are here, if the underlying expires and you're out of the money, all these lines go to 0 down here. If you're in the money over here, and time goes to 0, all these lines would go up to 100. So, with 60 minutes to go, we're trading out of the money option. Let's say it's maybe at 2008. You know, theoretically, and this is with a given implied volatility, let's say it's 25%. Because remember, implied volatility is also a component that enters into a binary option pricing model, so you always have to consider volatility. So let's say that implied volatility of 25% with 60 minutes to go, the theoretical price for the underlying trading of 2008 for a 2010 strike binary option would be around, let's call it let's just call it 35. It's just below this 40, 30 would be halfway, so let's call it 35. If the underlying, you know, trades around, trades up and down, but then maybe time passes 30 minutes, and the underlying still, you look back at your at the quotes, and remember the bid offer or the bid ask are going to be on either side of this theoretical value. So if it was 35, it might be trading 33.38, something like that, or 32.50, 38.50, something like that. You're going to see a bid offer on either side of the theoretical value. If it's trading back around that 2008 price 30 minutes later, you know, and you check in at this binary option value, it's now maybe worth 30. So the only thing that's happened is 30 minutes has passed, but it's lost $5 of that value. We go, maybe we walk away, come back 15 minutes later. Underlying maybe traded up a bit, traded down a bit, but hey, we look at it right when it's at 2008 again. Oh, look at this. It's now maybe down to 25. So we've lost some more value. We look again with 5 minutes to go. And hey, the underlying still 2008. This thing's only worth $10. So if the underlying sits still, or you keep returns to about approximately the same price, you're seeing this time decay in action. Even if it starts edging up, let's say we were looking at it where we put on this position, let's say at $35 theoretically with 60 minutes to go. Now price with 15 minutes to go or 5 minutes to go, let's say, is trading and it's trading at 2009. Hey, the option still lost value because the price didn't go up enough. All right, we'll get into the concept of delta in some slides, and you'll see how, depending on how far out of the money it is, you can get delta with price movement, but it might not be enough to overcome the time decay, the theta, and again, it might not be enough in certain instances to overcome that bid-offer spread if it's too far out of the money. So even if price is moving in your direction, but it can't get by that threshold, it can't get above that at-the-money price, which is the strike price of that option, that time decay is going to eat all this value away if you hold it into expiration. Here's what the graph of theta looks like, okay? So I've highlighted the out of the money section again. You can see this theta is always negative. What that is doing is taking away from the extrinsic value. And you can see, down here, way out, or this is again a 2010 strike price, or at the money is 2010. If the underline's all the way down here, your theta is less. If your underline's sitting, around this 2007 mark, your theta, your time decay with 15 minutes to go is greater. As you get closer and closer to at the money, the time decay is actually less. Now, this curve's going to change with time also. So if any of you have watched our prior webinars, you know that theta, every minute the time changes, this curve also changes. So this is just taking a snapshot. And every time implied volatility changes, this curve can change too. So there's multiple moving components to all these graphs. This is a snapshot with a hypothetical 15 minutes to expiration. So you can see how the curve is, that at a certain distance out of the money, the time decay is the most. As you get farther and farther out of the money, the time decay is not as much. Why is that? Because there's not as much extrinsic value left. All right, so the time decay is slower. And it slows down as you approach at the money at this specific time. Now, here is theta versus time. So, you can see we're again 2010 strike price. This is at a specific implied volatility. Let's call it 25%. This is how the theta curve changes in reference to time. So with 60 minutes to go, that would be this light blue line you can barely see. The time decay isn't that much. 30 minutes to go. It's more. This graph gets compressed because with 1 minute to go, you can really see the time decay is, if this thing remains out of the money with 1 minute to go, it's just generally this can nearly destroy all the remaining potential value in 1 minute. That's what this is showing you. Let's say this is just out of the money, okay, and it can't get into the money. Essentially, your time decay is going to take all that potential value away in the last couple minutes. That's what this is showing. You can also see that the time decay shifts towards the at the money price, closer and closer it gets to expiration. The theta will kick in at levels that get closer and closer to the at the money price. You can clearly see that between the 5 minute and 1 minute. That's one of the reasons I highlighted this graph, how it really starts pulling it in. So if it remains, this is, you've seen this. If it remains just out of the money, it's not getting to in the money, all that potential value, even with a couple minutes to go, it could be trading right around at the money. It could theoretically have around $50 of extrinsic value. Well, if the underlying can't get above that at the money price, all that is going to be lost in the last couple minutes. And that's, you can see with this huge downward spike of your theta. That's what this graph is showing you. Let's take a look at some binaries and market conditions, transferring some of this theoretical knowledge into, hey, what's suitable for trading these things? It's best to trade the binaries during busy market conditions. maybe a no-brainer, but you got to think about it. You want the price to have the potential to move, especially as you get farther and farther out of the money. And that's the one a lot of people look at. They go, I can risk $10 to make, you know, if it expires in the money, I get that $100 payment, so I've made $90 by risking 10. Yeah, but there's only certain market conditions where that could potentially happen, and they better be busy. If you have stagnant market conditions, you have no shit happening because this thing has to move. And I'll loop back to that, especially with the delta, because delta also, you know, you don't, when it's way out of the money, you don't get a lot of delta, which means even if the underlying's moving, your option price is not increasing that much. So if you want to exit prior to expiration, you potentially haven't made that much either. We just got a quick question from Ronald. Does theta versus time affect 5-minute binaries also? Theta affects every binary. Time decay is always. So if you have a 5-minute binary, every second that's passing, there is a time decay effect. All right? You're going to get the same curves. Now, the curves are going to be different, as I went over on this. Let me just jump back to finish this question off, then I'll pick up. It's handy to have this while I have this graph. Your graph's not going to look exactly the same, but it's going to have the same characteristics. Substitute maybe this blue line with 5, 4, 3, 2, 1. Your time decay is still going to get more extreme as that 5-minute binary approaches 0. Okay, your theta is going to kick in more and more. But it's going to look slightly different with the graph because now you're trading a 5-minute binary versus a, let's say this was a 2-hour binary with 60 minutes to go. But the concept is the same. Okay, Ronald? Good question. All right. Out of the money binary should not be put on in quiet or stagnant market conditions, especially close to expiration. Why? You're essentially paying for an option that has a little potential to get in the money, and that is risky. You can see these even at the money. When these things go quiet and they're just out of the money, maybe pretty close to at the money, and they're not moving, that time decay as it gets close to expiration just eats away at all that value. And unless those conditions pick up or unless that underlying can get some momentum into the money, all that value is gone. So if the trader expects market conditions to get busy and is trading a binary option with significant time to expiration, then it's okay to establish it during quieter conditions. Maybe, you know, the market's going to be going into a busy period in the next 15 minutes. You could put it on maybe with a 2-hour expiration or something, or a longer expiration. Because that's fine. You're going into busy conditions and hopefully it will pick up. If the conditions don't get busy, though, you have to take that into consideration because that theta, as it gets closer and closer to expiration, is going to eat away at that extrinsic value more and more and more. And it gets harder and harder for you to make up that loss of extrinsic value. For example, a US 500 binary option expiring at 11 a.m. being put on between 9 and 9:30 since the cash equity markets open at 9:30 a.m. That's fine because cash equity markets are open. It's going to create busier market conditions for the S&P 500 most of the time, unless there's some big report, unless there's some news event or something's happened that's maybe caused the market conditions to go stagnant, which can happen. But let's say it's a normal trading day, and volatility and price action pick up when the cash markets open. So, hey, let's say you establish something just before that, you're going into the expectation of busy market conditions. Busy market conditions lead to a couple things. First, it can lead to trending market conditions, which are required for out-of-the-money binary traders. You need this thing to be trending. Even if you're not going to hold it to expiration, you need the underlying price, like for a long trade, you need it to be going up. If it's not going up, you're not generating delta, which it will increase the price of the option. Time decay is working against you. So you need these trending market conditions, which happens generally in busy market conditions. Second, it could lead to stable or increasing implied volatility, which is also very beneficial to out-of-the-money binary traders. we'll get into the Vega component, which is the implied volatility component. The trader does not want price action to remain far out of the money for an extended period of time or move and remain at the money when the binary is close to expiration. You want this thing to get beyond at the money and hopefully beyond at the money by a fair amount, because if it's trading right around at the money near expiration and that settlement index ends up on the other side either at the money or less than at the money for a long trade, that value is all gone on expiration. You want this thing to be in the money. And next week when we turn in to show how Theta really applies to, hey, now it's in the money, and now I'm capturing all that Theta, and I want that Theta. I want that thing to be in the money because now it's getting closer and closer to that theoretical $100 value. All out-of-the-money binary options would need to have a trending market which will take them in the money. The further away from the strike price the option is trading, the stronger the trend needs to be. If you're looking at these ones that are really far out of the money and trading for a really good bargain price, like, hey, I can put this on at a really cheap price and have a potential of making that $100. Well, you better have conditions that could lead to a strong trend kicking in. This thing's got to move towards at the money price. Even if you want to exit it early, it's got to get there so you generate the delta to have the price increase. I just talked about Vega. Let's take a closer look at Vega. An increase in underlying volatility can lead to an increase in implied volatility of the binary option. It doesn't have to, but many times when the underlying gets more and more volatile, the implied volatility of the binary option will go up. This is beneficial to the out-of-the-money binary option trader if the price action remains a certain distance out of the money. So let's say the underlying, let's just say it's trading back and forth, it's getting maybe more volatile, so the implied volatility is going up, but let's say it's trading back and forth and it's still remaining in the out-of-the-money position. That implied volatility can increase the extrinsic value of this binary option. The out-of-the-money binary option trader does not want the implied volatility to decrease because it decreases the extrinsic value of the binary option. As time approaches expiration, the effects of implied volatility shifts closer to the strike price of the binary option. Every 1% increase in implied volatility increases the price of the out-of-the-money binary option. Let's take a look. Hold on. Conversely, every 1% decrease in implied volatility decreases the price of the binary option. Let's take a look at the graph of this. So this is now Vega. Again, 2010 strike price binary option. So this is out of the money. The underline's below 2010. You can see how, and this is with 15 minutes to go at a specific implied volatility, let's call it 25%. You can see how, as we approach the at the money price, as we get closer, Vega becomes more and more substantial and then drops off again into zero right at the money. But anytime this Vega is positive, it is increasing. Every 1% increase in implied volatility is increasing the price of your binary option. So if the underline's at 2007 and the implied volatility goes from 25 to 26%, your extrinsic value of the binary option is going to go up for roughly $1 in this example for every 1% increase in implied volatility. But if you were at 2009, every 1% increase would only increase $0.50. If you were at 2000, let's say 5, it would increase roughly $0.50. Now this is with 15 minutes to go. And the specific implied volatility. All those things are changing, so this is another curve that changes over time. Let's look at the price. We just showed a Vega. Here's how it relates to just the price. So we're out of the money. If we're trading at 40% implied volatility, let's say we're at 2008, and you might notice how this is very similar to time, and we've reviewed that in prior webinars, how implied volatility and time changes have many of the same effects on these options. But if we're trading at a high implied volatility, let's say 40%, underlines at 2008, and the implied volatility is dropping, let's say it drops down to 10%, and we're still trading at 2008, and this is a specific time to expiration, look at what happens to the value of that option. Okay, let's say that happens instantly. We all know it changes over time, but let's say, you know, you're trading with 30 minutes to go. This is theoretically worth 35 bucks. And implied volatility all of a sudden decreases from 40 to 10%. That option that was 35 is now trading maybe at 5. The only thing that changed was the implied volatility. That's what happened when implied volatility goes down for you're long this option. It goes down. Uh-oh, not good. The underlying's sitting there. Now, you know, if the underlying just goes stagnant, the odds are implied volatility can be falling unless we're going into a big news item or report. But let's say the conditions are such that implied volatility is falling. Now your underlying stagnant and your implied volatility, that's a double whammy. So every minute that passes, you're losing value. Your implied volatility is causing this thing to lose value, and price is not moving. So unless price picks up and gets this thing in the money, you're toast. So why did I say we want the conditions where at least implied volatility should be stable? If it's stable, that's not hurting you. Changes in implied volatility aren't hurting you. So if implied volatility is staying at 25% during the life of this trade, great. Or if it's rising, fantastic, because now the option value is rising. Also, implied volatility rising means the option market makers, they're pricing in the prospect of more volatility in the underlying. More volatility can be a benefit because it could take it in the money. It could also be hurt you, more volatility, because if it's going the wrong way, if you're long and volatility is to the downside, this could take it farther out of the money. Keep that in mind. Volatility, implied volatility is rising, helps your position. Volatility of the underlying that's going the wrong way can hurt your position. It can help it if it's going the right way. Vega versus time. All right, out of the money. So you can see what happens to the volatility component as we get closer to expiration. Well, volatility components, you know, when there's more time left, affect and the underlying is trading farther out of the money have a greater effect. But as time approaches expiration, the curve shifts in. So, you know, volatility changes when you get closer and closer to expiration, only affect your position if it's trading closer to at the money or closer to the strike price. If you're trading deep out of the money and volatility is going up, but you only have 5 minutes to go, it's not helping you that much. Whereas 60 minutes to go, it can be helping you. If it's still trading down here with 5 minutes to go, or if you're looking to put on an out of the money position with 5 minutes to go, saying, oh, I think implied volatility is going way up. Well, you're not going to get much benefit if you're a certain distance out of the money. This curve shifts closer and closer to the at the money price, which is right here. Okay? It shifts as time decreases. So there's a time component to Vega, and as you get less and less time, volatility effects only affect your position as it gets closer and closer to at the money. That's a key thing that people should know. Now, that's an advanced concept, and you might have to review this a couple times, and it might not apply to some beginning traders, but as you get more and more versed in trading these things, keep the time shift component to the volatility in mind. Let's take a look at delta. It's important that the trader understands the delta of trading an out of the money binary option. The delta is the amount the binary option price will move in relationship to a 1-point move of the underlying. So if the delta is 0.2, or we can call it 20, because it's always going to be less than 1. So if you see it on a scale of 0 to 100, all right, that's more of a percentage. If you see it on a scale of 0 to 1, you know, 0.2 would be 20%, or it would move 1/5 as much as the price of the underlying. If delta was 0.5 or 50%, it would move half as much as the underlying. So delta of a binary option varies greatly depending on the time until expiration and the distance the option is from the strike price. The farther from the strike price, the lower the delta. When the binary option gets closer to the strike price, the delta increases. This is especially true when the binary option is close to at the money and as expiration time approaches. Let's show this graphically. Here's the out of the money. Here's right at the money. This is with different times remaining to expiration. Here's your price of the underlying trading. We're at a 2010 strike price binary option, and this is with a specific implied volatility, maybe 25%. Here's what I was alluded to earlier. If the R underlying, let's say, is trading down here 2004, 2005, and you're looking on putting on one of these really cheap out of the money options, your delta, even with 60 minutes to go, might be only 5, or which would be 0.5, which means for every point that this thing's the underline's increasing, going up in your direction, your price of that option is not increasing. It's increasing 5%, okay? 5%. That's nothing. Let's say you're 2005, we go to 2006. You're still right around that 5%. Until you get pretty close, until you're getting closer and closer at the money, you are not. Your delta is not kicking in. Now, like when you get closer and closer, let's say, with 60 minutes to go, now we're trading just 1 point lower than the strike price or at the money, you're maybe at 9. And then as you get closer and closer to expiration, it's really kicking in. Your deltas start kicking in. So as it moves, it starts increasing in value. That's where a lot of people put on this. They put on these deep out-of-the-money options. The underline is trading at 2005. It moves all the way to 2008. And they watch their option, and it only went up maybe 20% in value from where they put it on. Yet the underlying moves 3 whole points in their direction. And they're looking at this going, I was right. It moved a lot in my direction. No, it's still out of the money, but it moved a lot. But I didn't see the price go up that much. Maybe I didn't even make enough to, because you're buying on the offer. If you're going long and then you're selling on the bid, you might not have even made enough to overcome that bid-offer spread, even though the underlying moved a certain distance in your direction. This is, I think, one of the most critical parts I want you guys to understand. This is why you have to consider the delta component if you're not considering holding these things to expiration, since your delta does not really kick in until expiration gets, closer and closer to 0, and until it gets closer and closer to the at-the-money price. You can see the underlying move a fair distance in your direction that doesn't quite take it to in the money or doesn't quite take it to at the money. Yes, and your option price has gone up, but it has not gone up a lot. So it's one of your considerations if you're going to not hold these trades to expiration. Let's say you choose even the wrong price. Let's say you choose the wrong strike price and you choose an option when you put it on that's too far out of the money. This thing the underlying trade in 2005, it only makes it to 2009 in that couple-hour window, maybe the time before you put it on. That wasn't, you made a little price increase, but now as it gets closer and closer to expiration, all of that theta starts kicking in. Anything it made, is being eaten up in time decay. This gets really critical in these binaries if you choose strike prices that are too far out of the money because you're not generating a lot of delta. And I really want you guys to understand that. So it might look like a good bargain, but it's really not a good bargain if this option cannot get into the money, if the underlying cannot get this into the money or at least close enough to at the money so you can exit it at a profit as it goes into expiration, because it can get some pretty good delta going into expiration, but you're still battling time decay. Now you see, with very little time to go, and I know you guys have seen this, with very little time to go, options that are really close to at the money, they can, or slightly in or slightly out, but they're really close to that at the money price, they can change in value very rapidly with very little time to go. Why is that? You see how much delta this thing gets. with 5 minutes to go, even with 5 minutes to go on this, and pretend this was a 2-hour binary. You know, this is with every point that the underlying changes, you're changing it roughly 25%. So this thing can change rapidly. With 1 minute to go, this thing can change, and with this implied volatility, over half the value of the binary option can change with a 1-point move in the underlying. And I know it makes perfect sense. You know, the binary goes from slightly out of the money to slightly in the money with a minute to go. Boom, that value explodes from nearly, hey, this thing could be worth maybe 10. No, now it's, hey, it's worth 90. Well, that's because the delta kicks in. Closer and closer you are at the money with very little time to go, that delta kicks in. That's why it's also dangerous trading these things into and holding them into the blackout period, you know, because if the underlying swings the wrong way against you, that option, this is where you see it, oh, like, you know, it was worth 90 and I could have taken it off there, now it expired worthless and I couldn't take it off because all that delta, if the underlying goes the wrong way, that delta is gone. And then all that theta just, you have extrinsic value only, and all that extrinsic value is lost going into expiration. I want you to think about where you are putting these on in reference to where you think the underlying is going and how far it's going to go into the time. If it's not going to get into your in the money position, you're not going to generate a lot of delta unless it's very close to expiration, and that time decay that we went over earlier could eat away that position very rapidly as it gets into expiration. Exiting out of the money binaries before expiration. This is what I was talking about. Sometimes it's necessary to exit binary option trade prior to expiration. One of the challenges with trading out of the money binary options that are not close to the strike price is that there's very little delta, as I covered. This means that as the underlying rallies towards the strike price, the binary option will not increase in price very much unless the option is getting close to at the money. Therefore, if the trader must exit the option early and the option price is not close to the strike price, the trader may not see the binary option price increase substantially. You may see a slight increase. You may not even see enough increase to overcome that bid-offer spread. Non-optimal conditions. We've just outlined some of the conditions we're looking for to consider entering an out-of-the-money binary option. Let's rephrase them and look at what some of the non-optimal conditions might be. We are not looking to trade out-of-the-money binary options in quiet market conditions with very little movement. You're not going to generate the delta if it's too far out of the money. That implied volatility could be going down against you. Both those things are hurting you, and then as that time decay kicks in, especially close to expiration, it's eating away all that extrinsic value. We are not looking to enter these out-of-the-money options that are far away from the strike price with very little time left, unless you have it underlying that is like has huge momentum kicking in and can make up that with that delta as it gets closer and closer to the at-the-money price. That's a deadly combination, taking these binary options that are too far out of the money with very little time left. You're not going to get that delta, and unless that thing can get to an in-the-money position, you have no hope of making money. Significantly decreasing volatility combined with stagnant market conditions drastically hurts the out-of-the-money binary trader, especially close to expiration. So, some examples of when we would not consider putting on out-of-the-money binary option trades. Early evening trades in currencies, usually in equity, indices, and commodities, or any time it's really stagnant when you have that tightly bound up trading. You know, it's just trading in a range. Now, there's different things if you're putting on something really at the money that could kick into the money, you're getting something really close to that at the money price, maybe, but it's still dangerous. A long time before a major report release. For example, putting on an out-of-the-money binary option at 12 p.m. that expires at 2 p.m. when there's a major Fed announcement that's expected at 2 p.m. Why? Because price can go stagnant, and then all that time decay is eating against you. Any price movement you have, if it's little underlying movement, you're not going to get a lot of delta. Therefore, even if you want to exit this thing early, you're not going to be making a lot of money because you're not generating a lot of extrinsic value, and there is no intrinsic value if it remains out of the money. So all that time decay will kick in, and if implied volatility is going down or remaining stagnant, it's a problem. Now, if implied volatility is going up, that's fine, but you should have a position that's closer to at the money, and you need to exit that thing if it's not going to go into the money well before expiration, because any benefit you got from the increasing implied volatility can be destroyed rapidly by that theta as it gets close to expiration. Let me turn this back over to Bob to walk you through an example, and then we'll come back and see if there's any questions.
I think it's great that I get to do the optimal example and Mike gets to do the non-optimal example, because I'm the positive one and he's the negative one. It makes me happy.
Oh, is that how you view it?
That's how I view it. That's the way I view it. What are you going to do? All right, optimal example. Conversely to Mike's negativity. Here are some optimal conditions when a trader may consider an out-of-the-money binary option trade. A trader has a strong directional bias with expectations of stable or rising volatility going into busy market conditions. You see a trend, that trend has dipped, you're going into a busy report, the option you've chosen expires through the report. That could be stable or rising volatility going into busy market conditions. The open of, if you're an overnight person, if you're an insomniac, the open of the London session for FX. Remember, you can trade FX with binaries. A lot of people ignore that, and there's some busy sessions at the London Open, which is about 1 or 2 a.m. depending on where you live. That's another good time to look at those things. But let's review a path trading setup that would be suitable for trading an out-of-the-money binary option. So we're going to do a long example, just like we've done long examples for pretty much everything we've talked about. Just the reverse is a short example, but it's easier for us to just talk from the long side on these. So what you have up here is you have various binary options for the US 500, and you've got a US 500 chart here. The US 500 closes beyond a path significant level, that's a proprietary thing that we teach, into a clear path move, which is also a proprietary thing that we teach. The significant level on the chart here is this 201 area right there. And you can see a close up there, moving into a clear path represented to the left here. And it's moving from a horizontal channel. Now the target is based on the horizontal channel breakout, which was here. And that target is at around 206. Okay, that again is something that we teach, but just trust us on this for now. That's the kind of thing we'd be looking at. So the target's based on the horizontal channel breakout, and it's 2006. The binary trade not entered yet due to poor reward to risk. The reward to risk at this point was just awful. So now we get a pullback, and we look to enter a 2003 binary option on this pullback toward the significant level. Remember I told you the significant level was at 201 here. So the market closed up into it, into this clear path move, coming out of this horizontal area here, what we also call congestion, and then pulled back, giving us an opportunity to get in at this particular significant level, or at least close to it. So a long binary position was entered or established at a price of 43.25. And you can see that right up there, 43.25 buy is what we ended up doing. The target of 2006 was reached, and we took profits on the 2003 binary option when it was trading at 81.75. Now you can see it blew through it, right? It blew through it fairly substantially. But still, because we had a plan in place, we take our profits. At this point, when the market has reached our target level, this is now our profit, and we're looking at a difference of about 18.25. I'm risking my profits here, the difference between 81.75 and the 43.25 we paid, to make another $18. It's not worth it for us. We follow our plan, and we go ahead and exit this. This is an example of the time to trade along out-of-the-money Nadex binary. So in this webinar, we covered various aspects of trading out-of-the-money Nadex binary options. We examined how some of the Greeks affect binary options, and we also looked at the optimal, that would have been me, and non-optimal market conditions, which was Mike, which can help a trader determine when to trade out of the money binary options. Now again, as with most of the webinars that we do, you probably need to review this information multiple times and then determine how this information can work to further help you successfully trade out of the money binary options within your trading strategies. So next time, we've got another one at the same time next Tuesday. We're going to look at trading Nadex binary options that are in the money. We'll again look at the market conditions that are beneficial and detrimental to trading the binary options in the money. It'll be helpful for a trader to again review the Greeks. If you haven't seen our series on trading the binaries, please go back and watch those if you have time, if you plan on attending the next one. It'll be helpful for you to review the Greeks and the various characteristics of them and how they apply to Nadex binary options. So before we take any questions, we'd love it if you'd follow us on Facebook, follow us on Twitter, @path_trading. I guess you would like us on Facebook. And visit us at pathtradingpartners.com. We've got a lot of free stuff in there. And please sign up for our webinars. Most of them are free. We do have some pay-for products in there as well. We'd love it if you guys would check out. And most important to me, please listen to our podcast, The Money Path, which can be found on the website as well. We've also got several blog articles. So there's a lot of stuff for you guys to go through for free before you decide to potentially take the plunge into one of our paid-for courses. So we're very happy to have you guys again, and we're also very happy to take any questions if there are any for us at this point.
And you can specify if you want the positive or negative answer.
Do you use the Nadex chart to find your entry trading positions? That's from Chris. Yes, we do, Chris. I use Nadex charts pretty frequently. Now, the reality is you don't have to. You don't have to do that, but I do use them. I know Mike uses them as well. So we do have a couple of other platforms that we use for some other things. And if I'm looking at a Nadex binary, I happen to have the other platform up, I'll look at it. But the main thing is that you learn to trade these things, not where you get your analysis from. Your chart entry positions can be Motive Wave or somebody else. It doesn't have to be on Nadex. The more important thing is you learn to trade these products and you imply your opinion in the market through the Nadex product. What happened in the next strike price up on that example? I think it was 22. Let's take a look at the example. I'm not sure what you mean, what happened to the strike price. What do you mean, Stephen? What do you mean by what happened to it? These are just screenshots. There could have been strike prices in both directions at this particular point in time, but we're just showing the ones that we're trading, so not quite sure what you mean by what happened to it. You want to look at what the price action was on it? Is that what you're saying? We could do that. But you know what you're doing already, Stephen, just for the record. You know what you're doing right there is you're sitting there and saying, okay, I want to make more money, which return chasing, and this is what I said in the beginning of the presentation. I said that one of the things that I give you guys that other people don't is I served as a fund of hedge funds investment officer, and we would run screaming away from return chasers. Okay, you don't want to necessarily, it depends on the situation, but you don't want to necessarily reach all the way up to the target. Okay, first of all, we're talking about out of the monies. Yeah, they're all out of the money. But you're looking at the reward to risk here, as opposed to what's a more likely trade to do, or what's a more likely event to happen. We have a target there, yes. We definitely have a target there. But what's the higher probability trade? Well, for it to get to 206, it has to get to 203 first, right? So don't always go with the best risk to reward because it's skewed that way for a reason, right? So yeah, you could have entered this one at 2250, and then on the next one, when it reached 206, it would have been worth 48.25. Not that much, right?
One of the things when I pick targets for binaries, I want my binary to be, I want it really to go through at the money, and I want it to be in the money, okay? I get a lot of that delta as it goes from out of the money, at the money, into the money. That's where you make up most of your delta component. All right, and I don't want to risk it falling back out of the money, where that time decay can really eat away. So I take, let's say I thought this thing was going easily to, let's just hypothetically say in this example, I thought it would be going to 2010. Let's add a firm price target at 2010. I wouldn't even be necessarily choosing that 2009. All right, oh, well, look, even on this screenshot, look, if it goes all the way to 2010, look, I could buy that 2009 right now at $12.50, and if it gets that 2010, oh, it's in the money I put on for $12.50, and now, oh, it's going to be worth that 100. I want something that, you know, I don't want this stalling out just short of 2010 or getting to that 2009 price close. Remember, if it, let's say you're going in expiration and this thing only made it to 2009, now it's trading at the money. You're going to be trading on that both sides that $50 range. And if it doesn't get to the in the money aspect, that thing can go to zero. So that is critical. I want this thing, for anything, especially if I'm holding it into expiration, I want it to be in the money and beyond that at the money price by a fair amount. And there's different ways you can measure that. You can look at the ranges of bars. You can do a lot of things to figure out, to optimize what kind of strike versus target you want. Okay? But to say, to try to pick something, you know, just for a slightly better reward to risk, that could also risk getting pinned at that at the money price or end up possibly out of the money, as I showed you with the theta kicking in, can be very dangerous. That's where I talked to a number of binary option traders, and they get, I call it penny wise, pound foolish. They try to fine tune it so much with their target and try to scrape every last aspect out of the strike price they're choosing, that they're actually putting themselves in a worse position because they get too cute by picking strike prices that are too far out of the money, and either the momentum doesn't get it there, or it goes there and then it falls back into out of the money and all that time decay eats it, or it's right there at the money price and we're going into expiration, and instead of, you know, they don't know which side of expiration that thing's going to end up on. So they actually didn't make as much because they got too cute with that.
This is part of the reason that we started this webinar series, Steve and everybody else who's still in here. You'll notice at the very beginning of this, we talked about at the money, out of the money. Most people will look at it because of the reward to risk, right? And the reason they do that, it's greed driven, and this is very natural, okay, very, very natural. It's not something that's a criticism in any way. It's a very natural, normal thing to say, well, you know, it went to 206, so why don't I do twice as many of the other ones and make more money, right? Because you have a limited amount in your account and there's no margin. That no margin thing in Nadex is a massive positive. It's not a negative. So you have to focus on your analysis, and that's just what Mike was describing when you see the way the delta reacts and the extra risk you're taking that is not signified by the amount of risk that's here on the ticket. Right? It's the risk of your trade actually going where you think it's going to be, right? That's really what it is. So, Daniel says, do you guys do any 5-minute trades? I do not, Daniel. I don't do any 5-minute binaries, no. I don't know, I don't think you do either, Mike, do you?
I have. I can only look at them with very specific market conditions at very specific levels. And one of the things is you have the longer the time frame, the less that noise comes into play. There's always noise in the market, but the lower the time frame, the more noise, you know, can even overrule a trend. So that's where, when you're on these very short binaries, they can get tricky, because that noise, even let's say you're long a 5-minute binary, that noise can affect you could be right on the direction, but that noise can drastically affect your trade you know, even in the last minute, and you know what, they go quiet in the last 30 seconds. So, you know, there's unless that thing is substantially in the money, noise can really play havoc with those. So you have to have a very specific system, and I found very specific market conditions that are suitable for those.
You know, those are a really tough game, Daniel. If you've struggled with trading at any time in the past, you should go to a little bit longer dated binaries, a little bit longer duration to start your career. Going off of what Mike just said, Chris just asked, how does one learn the path proprietary trades as shown in this webinar, as well as pretty much every webinar we've done, Chris. We've shown one or two. In most of them, not everyone, we've shown examples. You just go to our website, pathtradingpartners.com, and there's a place, right now we have one of the methods up there for sale, and then the rest will be up there probably in the next couple of weeks. But one of them is up there. And people, you know, just to play a little bit off of what Daniel was saying about the 5 minutes, and this applies for every market, people tend to think that because you're in the trade for 5 minutes that you're not exposed to risk. Here's one of the beauties of Nadex, okay? Not just binary options. Mike and I don't talk about any binary options except Nadex, and that's because they're regulated, right? Nadex is not a binary broker, as you guys know, right? And they're not an over-the-counter product with no regulation. They're regulated by the same people that regulate the CME group, regulate the NYMEX, okay, the CFTC. You have an honest-to-goodness product that allows you to exit early. A lot of binaries don't allow you to do that, right? Well, a lot of binary products, you have to stay in until expiration. So you've essentially got a trading tool that allows you to do a mix of short and long-term durations, okay? And that short-term gain, everybody says, well, I'll do 5 minute and 1 minute because I just want to be in and out. I don't want to take a lot of risk. Well, you know your ultimate risk, and Mike and I teach ways of actually kind of cutting your risk even more, but we really can't get into that right now. But you know, with the binary products, your risk is limited to begin with, so you don't have to worry about being in the 5 minute binaries because you want less risk. You want to worry more about your position sizing and your analysis, your method and your process, more than you do how much you're going to make and how long you're going to be in the trade. How long you're going to be in the trade, as Mike just explained during the meat of this, matters for what trade you take, as well as all the other webinars we've done on this subject. But, you know, again, you don't have to worry as much. First of all, it's a myth in regular trading that trading shorter term charts means you're taking less risk. That's a myth. We could explain that in a whole other webinar. But so look at the other durations because it's just a much, much harder game. You don't have to go out to the weekly binaries, but just as Mike mentioned, longer term charts have more data. They have more data in each bar, in each candle. So those candles are more reliable.
Chris just asked a question, okay, and can I use Nadex charts to implement your system?
We are not platform specific. Go ahead, Mike, I'm sorry.
Yeah, you just answered it, so there you go.
Yeah, we're not platform specific. Yeah, we're not platform specific. I'm sorry to jump in on that, but I meant to say that earlier when, I don't remember who asked if you can use any platform you want with us. You just want to affect the trades on Nadex, obviously. Yeah, you can use the Nadex charts. Again, we like a company called MotiveWave very much. I use some Thinkorswim. It really, we don't try to dictate platform to anybody. I like Daniel's comment. That's what really made me look at Nadex, because you can exit compared to other binary options. What made us do this sort of joint education thing with Nadex is because they're regulated. Obviously, exiting early is a great thing, but a binary is a real product even if you can exit early. The exiting early is a definite advantage, but it's really the CFTC regulation means they're actually real people. They're a real company.
Yeah, exiting early makes it even more important that you understand all the components we go over in this in these webinars, especially time decay and how it affects your position, especially if you're not quite in the money. You know, how does the deltas and choosing the correct strike price affect? movement in the underlying, how much am I going to make in this option? Should it go in my direction, not get all the way into the money, and I need to exit early? That's where all these Greeks really come into play, since they shift over time with volatility conditions, because you always have that option to get out of the trade early, whether it's going for you or against you.
Yes, Chris, Motive Wave works on Macs, yes. It works on Mac.
And there's Motive Wave information on our website too, so you can go up there and see about that kind of stuff. So, again, we don't push any one thing. We're actually into strategies that work across different time frames, different products, that really focus on price action trading. We really look at the truth behind trading, which is why we show you guys the Greeks and everything else, and how these products and how markets really function, instead of just do this, do this, do this.
All right, great. Thanks, Daniel. Thanks, Chris. Anybody else, guys? Any other questions? And I put our site up on top there. And again, please download the Money Path. I like talking to you guys on podcasts. I don't know why.
So on the podcast, are you more positive than me?
I would say I'm always more positive than you, yes.
Well, I'm going to start taking my positive pills.
I'm less
Yeah, you
positive.
guys really should. We have a lot of fun on the podcast.
Yeah. I'm less positive than Chip, that I know.
And you can learn a lot just about markets by listening to me drone on and to Bob really teaching stuff.
I'm sorry, it's Nadex that happily allows us to do these webinars, and we really appreciate it.
Yeah, we really appreciate Nadex and allowing us to teach you guys all this information.
We do, but I have to say thank you to Chip, too, even though he doesn't want me to. I'm saying thank you to Chip also.
Now you have to hum a theme song, Bob.
Chip's a good man. What, Chip's theme song?
Yeah, Chip's theme song.
Enough about Chip. Chip's behind the scenes. He's like the Wizard of Oz. He pulls the strings. You really can't see him. And he's saying it's time to go. So, good night, everybody. Chris, thanks again.
Good night. Thank you, everybody.
We will talk to you guys next Tuesday at the same time. We'll have another webinar for you guys through Nadex. Thanks again. Thank you to Nadex. And thank you, Mikey.